Hej og velkommen til aftens webinar under Daytrader.dk og trading-eksperimentet med undertitlen Kan du slå børsaben? Som sædvanligt, inden jeg går videre, vil jeg lige sikre mig, at I kan høre mig. Hvis I kan det, må I meget gerne skrive OK i det lille vindue, som I kan se til højre på jeres skærm. Og også denne gang ser folk ud til at kunne høre mig. Er det sådan, at I også kan se min skærm med en abe? Det kan I også. Helt perfekt. Jamen, velkommen til. Jeg hedder Erik Borg, og jeg er medejer af Daytrader.dk, der afholder det her webinar, hvor vi i aften får besøg af leder af FX-strategier hos Saxo Bank, John Hardy. Inden jeg introducerer John, vil jeg kort fortælle om tradingkonkurrencen. Det er jo sådan, at man i den her udgave af trading-eksperimentet kæmper dels mod nogle trading-aber fra Asserbo, der skal symbolisere tilfældigheden, men også kæmper mod andre deltagere. De første 20 af jer, der melder, at I har slået børsaberne, vinder bogen Daytrader, og den næstbedste trader vinder en foldecykel fra Holberg Hus Cykler, og vinderen det hele får et mentorforløb hos den professionelle trader Peter Arndt. Konkurrencen er gået i gang, men man kan stadig sagtens nå at være med. Det kan man frem til den 4. december. I kan læse om reglerne og hvad I skal bruge for at dokumentere sådan noget ved at gå ind på Daytrader.dk og så gå ind under slå børsaben, og så kan I trykke på konkurrencen. Og der skulle stå alt det, I behøver at vide, hvis I ønsker at være med. I det her øjeblik kan I se, at aberne de er bagud med de nede med 3% i afkast, så det skulle være ret nemt at slå dem og vinde den her bog. Jeg vil derfor naturligvis opfordre jer alle til at være med. Det er nu engang sjovest at handle aktier, når man rent faktisk handler aktier. Det var alt om konkurrencen. Nu vil jeg introducere aftens oplægsholder, John Hardy fra Saxo Bank. John er ekspert i Forex-trading, altså valutahandel, og det er præcis, hvad vi skal høre om i aften. Jeg har flere gange hørt John Hardy på den amerikanske finanskanal CNBC, så jeg er stolt over, at vi kan have ham med i aften under omgivelser, der trods alt er lidt mere beskedne. Som altid er I velkomne til at stille spørgsmål undervejs. Det er sådan, at John taler engelsk, men forstår dansk næsten perfekt, så I skal bare stille spørgsmålene på dansk, og så siger jeg dem videre til John, hvis de passer ind i sammenhængen. Det er jo sådan, at John Hardy i 2015 blev valgt som den mest præcise analytiker i forhold til at forudsige valutamarkedet over en periode på 12 måneder. Derfor glæder jeg mig til at høre om i aften, og det gælder også om at spidse ører, hvis man vil være lige så god som John. Kan du høre mig, John?
Yes, I can.
Okay, I'll change the screen to you.
Great. So I understand that I'm showing my screen.
Yes, exactly.
Okay, can you take the screen back? I thought you had the presentation loaded, and I'll get that ready for you as quickly as possible. I apologize for the
That's okay.
For the confusion. Just a second.
Ja, så kan I jo sidde her og kigge på abernes åbne positioner her imens. Det var jo så heldigt, at aberne havde shortet Vestas, og forleden dag så faldt Vestas. Det er jo ikke noget, man sådan, som regel skal glæde sig over. Men lige i den her situation var det jo meget godt for vores portefølje her på Daytrader.dk, at aberne havde shortet. Du siger bare til, når du er klar, John.
I assume you can hear me still, yeah?
Yeah.
Yeah, just one moment, please. I need to download the presentation to my computer, and I'm just trying to figure out what the quickest way to do will be.
Det er helt fint.
First of all, the opening slide I have is one on Bitcoin, and I wanted to talk a little bit about Bitcoin because what happens when all of us go out and talk about our different asset classes, whether it's futures, whether it's equities, whether it's my specialty, currencies, and you open up the floor, you talk for an hour, you open up the floor for questions, and everybody says, so what do you think about Bitcoin after you've been talking about currencies for for an hour? Let's see, let me go ahead and, okay, I think I can take the screen back now.
Okay.
I've got it ready for it. I do apologize for that. This is my fault.
Ingen problemer.
And here we actually see a live Bloomberg chart of, I guess you can see that in the middle of the screen. We're down about $1,200 intraday, but we're still some, $2,000 above where we were trading on Friday. So talk about a crazy market. Back to the presentation. Okay, here we go. Disclaimer, first of all, listen up, folks. Anything I say here is simply my impression of what's going on in the market, where I think things may be headed next. You should please not take this as any individual or direct trade recommendation. I will indicate where I think things are going. I'm not going to try to keep that to any secret. I will also express uncertainty if I have uncertainty. So I'll try to be as honest as possible about my views, but do not take this as a trade recommendation, especially what I'm about to talk, and that is a little bit about Bitcoin. And that slide is not in here, but that's okay. The issue I have with Bitcoin is that it's is gone super exponential. So if you take a logarithmic chart of Bitcoin, you can see, in other words, what you need to do when an asset class has gone from 10 cents to $10,000, you can't look at a nominal price chart. You have to look at a logarithmic chart. What you've seen since 2015 at the price action has not progressed in exponential terms. In other words, not in a steadily sloped line on a logarithmic chart, but it's gone so-called super exponential. And what that means is that I think, and what this means is often when asset classes are considered bubbles and you see them go super exponential or parabolic, even on a logarithmic chart, I think the time factor becomes really critical in terms of how long it can sustain such a move. And I think what that means is if there is the next really big test is, now that it's done this super exponential move, how does it survive or can it survive the next really big correction? Now, whether that correction comes tomorrow or it comes not until Bitcoin is at $100,000 or at $1 million, I cannot say. But certainly it's gotten to be a much bigger beast than it used to be, trading at $10,000 and with a market cap that is soon approaching $200 billion, up there with the likes of the top 10 or 20 largest companies in the world in terms of market cap. And a couple of words of warning from that perspective. When novices are also getting involved, and the only reason they're getting involved is they think the next day's price action will go up. I think the next big test for Bitcoin is whenever this futures contract is launched. There are multiple futures exchanges that are vying for launching a future, and that'll give for the first time will offer a way for people to short Bitcoin, which is not really directly available now in an efficient way. And there's a couple, there's some that are saying, well, this will give people an opportunity to speculate on the long side in Bitcoin because maybe they're not comfortable with opening an account on a Bitcoin exchange, what have you. On the other, that is true. On the other hand, this is also provides a way for easily hedging on the short side if you do have Bitcoins that you don't want to transact out of. But you want to protect the price that you have and lock that price in. It, of course, it allows you a way to have a countervailing short position to neutralize your overall position in the market. And as well, if there are extensive rumors about this or that exchange being corrupt, Bitfinex being one of those, if you want to look into that, there's plenty of stories on that. I'm not making any accusations myself. There are some interesting stories out there. I'll follow up on those if you care to. But if there are large and dishonest operators in the market, you would have an ability. They would have the ability, without having to manipulate something on their side of things, in the actual physical market, to simply sell futures. And finally, my overall overriding concern with Bitcoin in the longer term is that no sovereign is running the show. Of course, that is the very idea. That is the very attraction for some, especially those looking to skirt, fiat currency or money printing, what have you. But in the end, every sovereign power has the supreme power of taxation over the land and over its citizens. And if the sovereign ever sees this technology as threatening that power, you can bet with 100% certainty that they will move in on the market to whatever degree they can, and you'll essentially become an outlaw in speculating in Bitcoin. That's a very longer term overarching concern I have. It doesn't mean it's going to happen immediately. The technology has run away, but that could be a concern down the line. So I think that's all I'm going to say on Bitcoin.
Det var nogle rigtig interessante synspunkter. Tak for det.
Okay. Yeah. As you can see, I'm not an expert at all. I talk about it a lot with my colleagues, but I'm not an expert at all. We do have an expert in-house that's looking at a number of things. But just those are some various aspects of this that I've talked about with my colleagues. So obviously, I've been on the negative side on the balance, but again, I will be the last to say that I know where the top is, and I'll be the last to say that it's going to stop now versus at $100,000. So I'm not going to tell you to do or not to do anything. So getting on to the global foreign exchange market, I'm just going to have really basic and really quick overview. I assume you can only see the PowerPoint and not my controls in the this GoToWebinar app. Is that correct?
Yeah, that's correct.
Okay, just want to make sure now I can see that. I can minimize that so I can see the slides myself. If we look at the market and why is it different from other asset classes, it is very different. It's generally not a passive asset class. It's not like equities or bonds where you're just looking to get in there and sit on it. Of course, I'm talking to a trading audience, but it's not really an investment asset class in normal times anyway, like other asset classes. And when you're trading foreign exchange, you're trading an exchange rate. So I'm going to go back. You're trading an exchange rate. I guess you can see my cursor, so I don't need to click or anything. And it's a relationship between two currencies. It's not, you are buying the one currency, but at the same time, you're selling the other currency. So you're both positive on one thing, but also positive on that thing or that currency versus another currency. So it's the relationship, the exchange rate. You're always buying and selling at the same time. Very novel relative to other asset classes. What are the advantages of trading FX? It's very liquid. It's available around the clock. If you're trading the major pairs, some of the minor currencies may generally only be liquid during the hours of that country. There's total transparency. It's an over-the-counter market, so in terms of the pricing, there's nobody, there's no exchange fee for getting a very, very, very high frequency update feed and being quite aware of the liquidity of that market, etc. Many would argue it has a very technical behavior, especially even intraday. For the most liquid pairs, I think some of those technicals have changed an awful lot. In my experience, the price action, for example, and I suspect there's an element of these algorithms that are changing the way some of the intraday behaviors unfold. And then for the more advanced traders, there's an extremely highly developed and very liquid options market. And because it's an over-the-counter product, but I mean by that meaning it doesn't trade on an exchange, so you're just looking for a counterparty to trade. And if you want to trade an over-the-counter product, the counterpart is there at all times to trade whatever it is you want to trade. So if you want a specific expiration date on an option at a specific price, you don't have to find some standardized contract. You just find your day and find your price, and there's a price for that. Maybe some disadvantages, not maybe, some disadvantages of trading FX, especially for the novice and especially for the over-aggressive novice. A lot of people out there, they want to speculate, and they want to speculate hardcore, and traditionally a lot of the attention on FX has been on the degree to which leverage is available. 100 to 1 leverage. In other words, for $1,000, I can trade $100,000 of underlying currency. There's a very bad lack of understanding on what that involves in terms of risk. With that kind of leverage, you can wipe out your account in a single day. So leverage is a critical thing, and the simple law of drawdowns, I'll get to that in a moment. As well, I think the fundamental inputs are constantly shifting what it is you need to focus on, what it is that's driving the market. Maybe a little bit less straightforward than buying and selling equities, especially, again, when you're not looking at an asset class that is simply, hopefully, slowly appreciating over time anyway. And again, it's not a passive asset class, my last point there. Just very briefly, an effective leverage on trading. Let's say you're able to transact dollar yen at 1 pip. Here I'm showing a price at 2 pips over here for dollar yen. If you're at 1 times leverage and dollar yen is trading around 100, which it has in the past, that's a 0.01% spread, if you will, a cost for the transaction. Trade once a day, every 250 days, you're going to have to make up 2.5% commission costs. At 50 times leverage, which I would never advise anybody to trade, but it's available, of course, you have to make up 25%, which means you have to make 33% to return from a drawdown. For example, it's 75% to back to 100%. And that's your law of drawdown. So if you're trading with less liquid pairs with higher spreads, that's more eating into your trading costs right away. And of course, the law of drawdowns means you lose 50%, requires 100% return to get back to what you started with. You lose 75%, you have to get 400%. Now, away from the bad stuff and onto the good stuff. Foreign exchange, what is it about? What drives currencies? It's about central bank policy and how that is going to move interest rates, especially real rates. When I say real rates, I mean what is the interest rate after inflation. So if you have a 12% interest rate, that sounds attractive, but if your inflation is 15%, you have a minus 3% real rate, and I don't like that, etc. So right now, it's very slightly negative in the US with a CPI close to 2. Although if you look at the 2-year interest rate, it's a bit higher, or it's about the same. So maybe it's about a 0% real rate. In Europe, you have a negative rate because you have inflation at around 1.5%, and you've got a yield of minus 0.4%. So it's a very ugly real interest rate. You also look at economic data, which is strong or weak, which is going to drive fears of inflation or overheating or not sufficient economic activity. And that is what drives central bank policy as well. So people are always looking at interest rates and real interest rates as a driver for currency. Where are those headed? So of course, just as with equities, it's not about where this earnings report is or last quarter, or maybe even what it is now. It's the trend, it's where it's going, what is the anticipation of future quarters that drives returns. The other aspect, and all this sort of interacts with everything else, is current account. So if you're a trade deficit nation, or if you're like Denmark and you have a massive trade surplus, this is important as well. A trade surplus is positive for your currency. It needs to be offset somehow by capital flowing out of the country. For Denmark, a lot of that capital flows out of the country in the form of savings, buying other stuff around the world, especially for pensions. And if you're a country like the US, you have or the UK, you have a large current account deficit, which needs to be offset by inflows. And if those current account deficits are growing or shrinking, or the surpluses are growing or shrinking, that is a big fundamental factor on a currency. And of course, government policies can influence any or all of the above. Tax cuts, could it boost growth? Is that going to mean the central bank is going to have to hike rates, et cetera, et cetera? And we can see correlations between interest rate spreads. So let's say I took the 10-year, the white line is the 10-year European interest rate versus the US 10-year interest rate, and we see how that develops over time. Europe yields less than US because of quantitative easing, because of low inflation in Europe, so it's at minus 1%-ish back here, and it's gone as low as minus 1.6, 1.7. And the trend turned around as the ECB started towards slowing its quantitative easing program, and euro-dollar took off to a large degree in sympathy with that turn. Now, one of the reasons the euro outpaced the actual tendency in the spreads in white is because you're talking about quantitative easing, which isn't really easy to quantify in absolute interest rate terms. And another one of the reasons why perhaps the euro has advanced so far and so rapidly against the dollar, besides undervaluation issues, is that over the last few years, the Eurozone current account surplus here in white has ripped higher to 3% of GDP, absolutely enormous relative to the historical approximately 0, especially led by Germany. Whereas the US current account deficit, still a deficit at 2 to 2.5% of GDP, has not really done anything. So that could be why the ECB finally climbing down from its policies, and all the time in the background you had a steady pressure on the euro to revalue higher anyway. And here we see euro sterling, which is in orange, approximately following the rate spreads for 10 years Europe versus 10 years for the UK. Occasionally you get big overshoots. Here was the September election in the UK, where Prime Minister May had an absolutely disastrous election, and people feared some kind of chaotic Brexit scenario. So the sterling devalued, in other words, lower versus the euro, so the euro's higher. Or actually, the fundamentals in terms of the interest rate spreads suggested less need to worry, and euro sterling reverted back lower. So what's interesting right now, here now in the last couple of days, yesterday in fact, we had a big breakthrough in the Brexit negotiations where it looks like they've agreed in principle on a so-called divorce bill. UK willing to put up a pretty considerable sum to pay for disentangling itself from the EU. And that has put, given quite a boost to UK rates and is seeing the spread lower. It's actually the lowest it's been since back in the beginning of this year. And we're seeing euro sterling being dragged lower over the last couple of days because of that. And you can quantify these moves. Here I've made a spreadsheet where I quantify these moves. And so you can see that the 2-year, again, sorry, I'm used to a different presentation program where I have to press on the screen to get the cursor to appear to show you. But for the 2-year top and the 10-year, sterling has seen a big positive shock yesterday. And this was taken actually earlier today, so that the shock has continued, and then in the 10 years as well. So these are big positive shocks in interest rates that can be seen. These are normalized to standard deviations, so you can see. And if you look at the actual trends in these currencies, you're seeing sterling picking up stronger versus its so-called G10 currency peers. Those currencies that have seen falling interest rates, those that have fallen the most, Australia, for example, Norway to a degree as well. If we look over the last 20 days accumulated, that's what this is showing here. And indeed, we see that these are the weakest currencies. So interest rates are a key. It's not the only key. It's not the only fundamental, but interest rates are definitely a key, and a lot of that linked to central banks and linked to the strength of the economy and inflation and how the central bank is going to react. And so dollar yen, similarly, almost one of the closest relationships you'll find. The 10-year US versus Japan bond yield spread, and then the actual dollar yen rate. So essentially, because Japanese bonds hardly ever move in terms of yield, at least not much, certainly not relative to US interest rates, you're practically trading US treasuries when you're trading dollar yen. Not always, you see some divergences, and there are other factors, but it's essentially what you're doing. Now, that picture is changing a little bit because we're starting to see, this is getting maybe a bit technical for some of you, or beyond your pay grade in terms of what you're interested in learning about Forex, but we'll talk about it. You've seen a massive growth in the Bank of Japan's balance sheet. So they've been buying 85 trillion yen of assets since they announced the last and biggest change in their quantitative easing policy. And they've not said that they're going to slow their purchases. Instead, they've talked about controlling the yield curve. Well, it's a lot easier to control the yield curve than it is to make enormous purchases. In fact, they've slowed their rate of purchases, even though they haven't said they're going to do so. So this is actually supplying a little bit of pressure on the yen to strengthen. But the Bank of Japan hasn't said anything yet, and it hasn't recognized that it's really explicitly that it's doing this. But it's sort of out there, if you will, as a big risk, one-off risk, once the Bank of Japan finally says, okay, our economy is growing fast enough, inflation is not where we want it to be, but we're going to finally have to slow down this asset purchase program. And what I mean by yield curve control, which is the policy they're pursuing now, is that they've taken 10-year interest rates and they've essentially put a cap on them. You can see it here. It's a very small chart, but it's they put a cap. First of all, they put a floor under them because they don't want 10-year rates to get too low because it's bad for banks if long rates are too low. So they made sure that long rates would be higher than short rates, but they don't want long rates to go too high because they're afraid that's going to work against the economy. It's a ridiculous amount of intervention into the economy, but that's what they're doing. Now, what becomes very interesting for the Japanese yen is, and this happened twice, in 2017 so far, where interest rates threatened to go a lot higher in the rest of the world, and we're dragging Japanese rates higher, but the Bank of Japan was intervening and announcing unlimited purchases of bonds to keep those rates from going any higher. And luckily for the Bank of Japan, interest rates in the rest of the world started going back down a little bit. So their policy has been tested, and critically so, twice. But the history of any intervention program will show that once it's tested hard enough, the central bank is forced to capitulate. It happened with George Soros in 1992 when he broke the back of the Bank of England. It happened in early 2015 with the Swiss franc when they abandoned their peg. pegs, and it actually happened in the Bank of Japan's history as well back in 2003, I believe it was, and when they were trying to defend a certain level in the Japanese yen. So just be aware that if interest rates are marching sharply higher, there is a pressure cooker situation in the Japanese yen. The longer they maintain this cap, let's say U.S. yields continue to go higher, and they try to maintain this cap, you've got enormous pressure cooker building because the yen will weaken as long as they insist on that yield target, because their bond market is not taking the pressure. So something has to take the pressure, and therefore it's the currency. And that's what we see here. So every time U.S. rates shoot up, which is what's happening when the white line is going up, U.S. rates going up very fast. Here they are at a spread of 220 basis points after being down at 140 basis points. That puts big pressure on the yen to devalue, but it will also put pressure on the Bank of Japan to stop doing what it's doing, and then you get a big blow up. And so I think there's a potential blow up in 2018 if, and that's a big if, but an important one, if interest rates go higher. If you hear an odd sound or two, that might be me taking a sip of water. Okay, hopefully you're with me so far. So the big questions with those, with that brief fundamental background behind you or behind us is what's going to be different, what's interesting from here versus what we've seen so far this year. This year's been a really crazy year in terms of how little has happened and how little volatility we've seen. But we think that's going to change next year because we have a number of things going on that raise the odds that something bigger is going to happen. And especially it's tighter central banks, and it's the main central banks we're talking about. So I already talked a little bit about the Bank of Japan. They're already reducing their purchases. They're going to remove even further support likely as their economy is virtually booming right now, and it makes increasingly less sense given that fact. The ECB has already promised to slow its purchases from January 1st, and it's supposedly going to stop doing QE in Q3. And then the U.S. Fed is already actually slowly reducing its balance sheet, which adds straight to U.S. budget deficits. And all of this means that the black line here is total QE, total world QE. If you look at all central banks, almost all of it being ECB in green, Bank of Japan in this reddish color, and the Fed in blue. So the Fed is actually shrinking the balance sheet, and these others are slowly tapering. So we have net zero QE by the end of next year. And of course, many believe that the main thing driving asset markets has been QE. So it's a very big open question. Can the market stand any real tightening?
John, der er nogen, der gerne vil have skåret ud i pap. Hvad tror du vil ske med yenen over for dollaren, hvis det her blowout sker? Altså vil den stige, eller vil den falde voldsomt? Det er der simpelthen nogen, der er i tvivl om.
Yeah, it's a bit confusing with the yen, because when you talk about the yen, it's always the right-hand currency in a currency pair. So you always talk about the yen crosses, whether that's dollar yen or euro yen or Aussie yen. What I can't scale pop, as you say, is that whether interest rates are going to rise sharply or not. But if they do, the first thing that happens, as long as the Bank of Japan insists on maintaining its yield target, or its yield peg, if you will, because what will happen is their 10-year yield will go up to that 10 basis points. It's going to sit there, and people will assume that the Bank of Japan is going to intervene, and they may do so. If yields continue going up elsewhere, the yen falls. So dollar yen, for example, would probably go up, and go up sharply, as long as interest rates, US and elsewhere, are rising. But
okay.
the moment the Bank of Japan says this is causing too much pressure on yields, and the yen is falling too fast, and it's going to mean we're going to have to pay more for imports, and people's cost of living is going to go up. It's going to create inflation that's uncomfortable, and it's going to be unpopular around the world. They'll be forced to change their policy. And at the moment they're forced to change their policy in this scenario, then the yen goes straight up, and it goes straight up violently. So dollar yen or euro yen or Aussie yen or whatever could fall very sharply because the yen is going up versus these currencies. Those other currencies are going down versus the Japanese yen. So do you see the two-way bit of what I'm talking about? Is if you fix, as long as the pressure cooker situation only develops if interest rates go up. So that's the key caveat to this, all this unfolding.
Yeah. Okay.
So if we're going to go into lower and lower long rates, this becomes a much more boring scenario, and then the yen is probably going up, but not going up in any sort of necessarily violent way. If interest rates are simply slowly falling next year, rather than rising again. Does that make sense?
Yeah, fuldstændig.
Hopefully. Okay. And then I have 1 or 2 slides here on the Norwegian krone. It's been getting a lot of attention because it's not been following the fundamentals, that it's been misbehaving, if you will, relative to a lot of fundamental measures. One of those being oil. So here you see oil in this sort of purple line. It was still a very high price for a long time, then started falling, and the trade weighted Norwegian krone, the black line. We can get into why this happened here. That had to do with the Norwegian krone being overvalued back here, but whatever. You can see how it, many people watch oil for the reasons why the Norwegian krone goes up and down. But wow, quite a divergence here that requires some explanation. And in fact, I've built some pretty simple models that try to indicate what euro versus the Norwegian krone should be trading. Here's the actual euro versus Norwegian krone in blue. My model, that is a simple interest rate spread plus oil model, suggests that it actually should be at the lower end of the range of the last couple of years plus. And if I include gas, by the way, gas is equal to oil in terms of the value of exports in Norway now. That's how much their gas has grown and their oil has shrunk. Suggests about the same, certainly lower relative to the current price. Instead, Euro-NOK is making all-time highs. What gives? And I'm not sure I know, but some things that we could point to that might be the reason is their so-called mainland GDP, which is their GDP without, but they try to maintain a GDP measure without their oil sector. It's growing at 2.5%, pretty decent. There's a lot of places in the world that are growing 2.5%, but it's only growing at 2.5% despite budget deficits, in other words, fiscal stimulus of 8% of GDP. If you take out the money they're earning off of their oil. That's a very large budget deficit to be running, and it's not sustainable especially if oil prices start to go down. I think that's one of the reasons. So an underlying weak economy, even though the growth is still there, it's being bought at the cost of lots of stimulus. And then I think there's a structural worry about the housing market, which is showing signs of exhaustion and showing signs of turning around. And if you look at the U.S. and the UK experiences with housing bubbles when they correct, and even in Europe, Spain, etc., where does the debt end up after a housing crisis? So the banks have it now, right, against the mortgage holders, those that are living in the homes and have issued the debt to buy the homes. You have a housing crisis, what happens? Are people thrown on the streets? Of course not. Are their debts written off? The banks don't like that. Are they everyone's simply allowed to default? It would kill the banks, it would kill the economy or the financial system. No. So what happens? They print a lot of money, and it all ends up on the government's balance sheet. So that private sector debt gets shifted to the public sector and ends up being in Norwegian sovereign bonds, if you will. As well, I think there's an element of people looking long term that Norway is not competitive without fossil fuels, and eventually they are slowly running down certainly the oil. The natural gas is going to take a lot longer to run down, and they're not competitive, and they're showing signs of not wanting to expand exploration because of the greenhouse gas impact. And we can see how much house prices have appreciated. In black here is Sweden, Norway is the orange, Denmark. This is as a percentage of GDP. This is Sweden, Denmark, and Norway household debt to GDP ratio. So it's even higher in Denmark, but that's because you have this very oddball mortgage market in Denmark, which is fantastic. But what does a fantastic market do? It allows you to have fantastically expensive houses with the Danish mortgages. But you can see that Denmark has leveraged up far, far less in relative terms to where it was in 2000. So it was at index 220 to 270 now, and actually has been deleveraging. So this is quite interesting. We've actually been deleveraging in Denmark on the private balance sheet. They've been leveraging up and up and up and up and up in Sweden and Norway. So this is a big macro risk, and especially a big risk if long-term rates turn around, or even short-term rates. And that's the case for all the small. I'm going to start rushing through a couple of these slides because I want to get to your questions. I want to get to a little bit on trading and stuff. It's the case that these are the countries with the highest debt to GDP growth rates in the world. So yeah, or highest private debt loads. It actually shouldn't read growth rates. This is just simply the highest debt loads per GDP. So you're seeing all the small developed countries: Sweden, Norway, Canada, Australia, all of them on here. And of course you have China and Hong Kong as well. And they require several multiples of credit growth to keep their growth engines running. So this is all an unsustainable, not to sound too doom and gloom, but you can't sustain credit growth of that rate. So eventually these are the economies that are most at risk if there is a correction in credit and if there's a correction in interest rates especially. So where do I see the major currencies heading in 2018? I think actually, ironically, in the short term, there may be some chance that the dollar rallies on tax reform. I'm hoping to get to that. In fact, this is a slightly earlier version of my presentation. I'm just going to flip through to see which slides I have. Yeah, okay, I'm missing some of the ones I thought I had. That's okay. But I do have the tax reform. Good stuff. All right. So dollar weaker versus the euro, the yen, and sterling. I think there's going to be a focus on current account, in other words, surpluses, especially Japan and Europe, massive surplus nations. Sterling has been discounted and is cheap for a different reason related to Brexit. Brexit maybe starts to finally move forward, and the U.S. is going very much the wrong way with its budget. And if Trump gets his tax reforms through, which it appears he might, that's going to worsen a lot more in the U.S. And the Fed slowing down its quantitative easing and actually reversing quantitative easing, becoming QT or quantitative tightening, is going to make it even worse. The euro, we see it higher on returning to broader fair value. It's still a little bit cheap. It's gotten far less cheap. And as the ECB tapers its purchases, asset purchases in January 1st. Plus, again, that ongoing massive current account surplus. Longer term, we have some concerns about Europe and all the similar issues that dogged Europe with the peripheral debt crisis back in 2009, 10, 11, 12, especially as we see very different ideas about governance and about the government and what the EU's role should be in the likes of Central and Eastern European countries, Poland, Hungary, even Austria to a degree, versus the traditional core. We think Merkel's leadership has been weakened in this election, et cetera, et cetera. So Europe is going to have to long-term get its act together and either become more integrated, or it's going to need to spin apart into smaller component parts. And but that's a very long-term issue. The yen is the cheapest currency of the majors, probably. Cheaper even than sterling on a fair value basis. Hard to believe, but that is the case if you adjust for CPI and things like that. And it's especially cheap given the strong growth. The only thing keeping it down is the Bank of Japan's crazy, wild-eyed monetary policy, which again, if interest rates rise, it could make the yen even cheaper, but there's some big snapback risk, significant volatility risk if it normalizes policy, steps away from that, yield curve control, etc. Sterling, we have our hopes to the upside, but it does need to see more progress on Brexit. This is one of the first most promising signs actually this week on that front. And actually, since I can simply share my whole screen, I can get to a chart. I don't need the charts I was thinking about earlier. I can just get to a live chart. Swiss franc, still too expensive, and it's not the safe haven it used to be. There's been all kinds of tax deals done with the U.S., with Germany to avoid the secrecy, banking secrecy of previous cycles. Not sure why that's popped up. And then we have the smaller currencies. We're not big fans of these. They're very poorly positioned for any kind of interest rate rises due to their housing markets, and their banks would need bailouts that transfer their debt to the sovereign balance sheet. And they still remain a little bit overvalued on average. Canadian dollar less so, but the Australian dollar, and especially we're concerned about the way China is going to transform its growth model as an especial negative for potential for Australia, because China needs to stop growing by sort of this brute growth of building too much and overexpanding infrastructure and construction, and needs to focus on transforming into a more finance-driven and consumption-driven economy. So you're going to see maybe less stuff getting dug out of the ground in Australia and sent to China. And there's some pretty hairy issues with the Chinese, how they plan to do this, but I think they're going to try to keep their currency stable. So there's been a lot of talk about the Chinese yuan being devalued. I don't think they want to devalue it, because that transformation to a consumption-led economy means you need a strong currency, and you want to encourage people to invest in China, and especially invest in Chinese assets and Chinese debt around the world, and see China as a source of stability, not of chaos and devaluation. So I think they will force their adjustments on the rest of the world by continuing to see nominal growth. So higher inflation and interest rates not maybe as high as the inflation rate, which helps you to reduce your debt, and forcing the rest of the world to make the adjustment. And even maybe pricing oil for trade in yuan instead of dollars. So that's a huge move that has massive implications for the US dollar's role as global reserve currency, and again, a massive issue that requires its own hour-long presentation. And then in emerging markets, we have some really some pretty attractive valuations here and there in emerging markets, but we also have very, very bubbly asset markets in general around the world. So I think we need to be careful about entry levels. When you have given we think 2018 is going to be a little bit of a rockier ride with bigger ups and downs than we've seen in this record quiet in 2017. It means that when you have these market events, people don't like to hold things that are not very liquid, and emerging market assets and currencies are not very liquid. So it's a question of fading the panic and buying when they get even cheaper in many cases, rather than simply looking at what is the value right this second. And briefly, and I think this is even one for you equity traders out there, and prick up your ears here if you've been getting bored by what I've been talking about before, because I find this interesting and highly relevant to today's actions in the market specifically. I don't know if any of you noticed the NASDAQ was down hard, but the S&P wasn't down so bad, at least last time I checked the screen. And the Russell 2000 was actually up. So what could the explanation be for that? Well, it could be tax reform, and here's how. And there's a great post on this, and I'm just stealing this straight from this post that I read on this today. But it's a compelling argument. And it's from a guy who I follow quite closely. His name's Kevin Muir. I believe he's Canadian. He has a blog, themacrotourist.com. Check out today's post about, it explains that very idea. He suggests that the market simply was behind on believing that tax reform actually could happen, that few people thought it could happen and haven't considered what the effects are. And the big ramp you've seen in equities, it's been a slow ramp, but a pretty steady ramp all year long, has mostly been momentum chasing in the so-called FANGs and the big growth stocks, and people are somewhat neglecting value. But what does a tax cut mean? What does a tax reform, especially for corporations, mean? Who does it benefit the most? Does it benefit your big growth company that's got a massive multiple on it and has a pretty thin layer of earnings relative to the value of the company? Or does it benefit the one that pays a massive dividend and earns a lot of money? It's just not growing a lot. Of course, it benefits more from here to tomorrow. If you get tax reform tomorrow, it benefits the one that has tons of earnings, because it's going to have a huge tax cut on those earnings. So suddenly you have to adjust all your multiples on your high income earners. So I think this trend could be very interesting. It could actually, ironically, also spike volatility, is his argument. And wouldn't it be ironic if all stocks fell because we need to buy value stocks to take into account this effect as people are rotating the themes here. So just be aware of that. I think it's a fascinating post, and I hadn't thought of that aspect of tax reform. I've been looking more at the currency effects, but and what are those current?
Hidden the macrotourist.com.
Themacrotourist.com.
Okay.
I may have that wrong, but it's just Google the macro tourist, and you'll get the guy. Sip of water there. So when Trump was elected, within hours, and we called this live, by the way. We at least we called the direction as soon as the initial spike, and there's this massive spike in fear, and then the markets came back pretty hard. to the upside, the dollar spiked lower and then immediately came back, etc. And we were trying to call that there in the dark hours of the Danish night, last November 9th. The anticipation was that Trump's program would get through. He would get tax reform, check. He would get a big infrastructure spending check, and that would invigorate the economy and invigorate inflation, and mean that the entire U.S. yield curve would need to lift off, and that would be very dollar supportive if that was to prove to be the case. Instead, he's done some deregulation moves, but he's largely not done anything yet. But it does look like he may get the tax deal through. It's a very cynical tax deal. It does nothing for the average person who doesn't really need a tax cut. If I'm paying $972 in taxes, which a lot of people do, or they pay almost nothing in income taxes, what the heck difference does it make them? Next year I'm going to pay $932 in taxes. It doesn't make a difference for me. But if a corporation, of course, gets a massive, it's mostly focused on corporations, it's focused on private business owners. So the argument, they call it small business, but most all of the owners of these businesses that have these so-called small business or pass-through business structures are actually massively wealthy. And one of the most wealthy of these, ironically enough, is Mr. Trump himself, who would benefit massively from this tax deal. Regardless of what you think of the morals of this deal, especially from socially democratic Denmark, and I do not mean that negatively, you have to look at what does it mean practically. And practically what it means is, yes, it could mean, of course, that some more U.S. corporations will look domestically for investments because their tax rate has been reduced to a more competitive level worldwide. Some small businesses will benefit greatly, the ones that are actually small. So you'll see a nominal positive effect on the economy. Sure, you might see homebound repatriation of U.S. corporate profits that are abroad. This is a key issue, but a lot of that is in dollars anyway, so it's not necessarily going to boost the dollar massively from that source. I think on net, the first focus will be that it is dollar positive, but the question I have is how long that dollar positive boost will last, because I think what we also have to consider is that it's going to blow a massive hole in the U.S. budget deficit, which is already worsening as we're going into next year, already close to 3% of GDP. It would be maybe 4% because the Fed is slowing it's shrinking its balance sheet, and maybe 5% if we add on these tax cuts. I mean, a 5% GDP deficit is pretty big stuff for the world's largest economy. And Asian countries are not, and world countries and oil exporters, with the oil price lower than it was before, are not building reserves like they used to, are not buying these dollars to offset this, to pay for this big current account deficit. So while the initial move here, maybe in the month or two to come, could be a dollar bump, this is bad news for the dollar in terms of and these other dynamics. As well, I think the potential boost to the economy could be a bit exaggerated. Yes, for you equity traders out there that are listening here, and others that are out there trading, it could mean a big revaluation to the upside for those chunky earner companies. But a lot of these tax cuts are supply side driven. That assumption, as many have argued, that was so great with Reagan's tax cut plan in the 80s, that you cut the taxes at the top end, and it trickles down, the so-called trickle-down theory. It trickles down to everyone because they invest more, and those investments see more jobs with higher pay, et cetera, et cetera. But in this economy, especially since the global financial crisis, it's the demand side that's the problem. And the demand side is not addressed at all by these reforms. It would be addressed far more by a massive infrastructure spend. So if you told me they were going to go further into debt on a big infrastructure spend, I'd be more interested in what it would mean for U.S. growth, because nominal growth would go up from that. Anyway, so I think they're learning the wrong lessons from the Reagan era. They think they're doing a Reagan cut too. What they don't appreciate is that Reagan also massively stimulated on the fiscal side with massive budget deficits, and that was perhaps what got the economy going as much as, or more than anything else, as well as the fact that the U.S. had massively deleveraged by having horrific inflation in the 70s. Right now we have low inflation and very, very high debts, where the starting point is entirely different now.
John, kan du igen skære ud i pap, hvorfor Dow Jones tilsyneladende er steget, og Nasdaq er faldet, i forhold til den forklaring, du kom med her?
Okay, so apparently my attempt to, I think it's explained well in the Macro Tourist post. If you want a slow read rather than me trying to recap in 2 minutes, I mean, I'll be happy to try again here. But
ja, men altså vi lægger også videoen ud, så folk kan se den bagefter, hvis de gerne vil prøve at forstå det.
So what is a growth company? It trades at a very high multiple. So you're buying its future earnings. So its earnings now are rather modest relative to the price. So if you're buying the growth story, you're not buying the fact that I'm paying 50 times PE. Well, that E is pretty small. So the E meaning the earnings. So if I cut taxes on that small E, it doesn't have a big valuation readjustment going forward. If I have a company that has pretty chunky margins and is not trading at a high multiple, it's trading at 12 times earnings, and those earnings go up 30% next year because of tax cuts, that's a big adjustment I need to make in the multiple, because suddenly I'm getting an even fatter dividend, much fatter dividend, in a very nasty low rate environment where I'm getting paid 2% for my so-called high yield corporate debt. So I think people will see that the value companies needed to be the ones that are making big earnings, but not showing growth, need to see a one-off adjustment in there to appreciate what corporate tax cuts mean for these companies and for the investors in these companies. I hope that clarified it a bit.
Yeah.
Okay. We're coming up on an hour soon, and I don't want to go through too much through this part, because I'd like to get to your questions and talk a little bit about trading. So basically, I was going to point out that you have to be very careful when you're looking at currency pairs where the interest rates are very different. These are so-called carry trades, and a lot of these carry trades are when you're long or when you're buying an emerging market currency. So, for example, the Turkish lira. If we go long the Turkish lira here, for example, versus the euro, this is a Bloomberg calculation screen, you can see that the exchange rate has fallen by half or more over this time period that I've identified. So it looks like you've just lost out horribly by owning Turkish liras. But Turkish lira yields a lot more. In other words, there's a higher interest rate there. So if you're buying bonds or short-term bills in Turkey, you're being compensated with lots of interest payments by holding those. So over time, actually, you've hardly lost anything by owning Turkish liras relative to the euro if you include the total returns from interest. So what happens is, here's the exchange rate, the white and blue line here. So euro versus the Turkish lira has gone up and up and up from an exchange rate of 2 to well over 4.5 currently. Again, looking like a massive loss, but it's actually rather modest because of the higher Turkish interest rate, which is now bordering on 14-15% if you're going out for 1 year interest on 1 year government bills. Now, if you adjust for the currency's level versus CPI, the so-called broad effective rate shown here in pink, so JP Morgan, you can see how cheap it has gotten. It's supposed to be adjusting for all these CPI and all these other factors. And the currency is about as cheap as it's ever been in the modern era. So for very good reason, because Mr. Erdogan is making himself as unpopular as he can around the world. With the U.S., they've gotten a diplomatic spat. He's also really cheesed off at his central bank for wanting to hike rates, saying it's on the wrong path. So it's showing political interference into a central bank policy. It's always bad news. Nobody likes that. Turkey runs a current account deficit, so it needs constant inflows of money. Nobody wants to send money there because of Erdogan, et cetera, et cetera. So all I'm saying is that it's discounted extremely heavily and for some very good reasons, but all you have to see is a change of behavior, some ray of light, and some revaluation, big revaluation can happen. So just keep your eye out for those, any key news items that indicate normalization, indicate he's going to let that central bank hike rates however much is needed to stabilize the currency, what have you. And to slow inflation, importantly, as well. Of course, inflation and a devaluing currency go hand in hand to a degree anyway. And then this is just to illustrate even more so. So the blue line here is the Argentine shilling versus the dollar, which has absolutely collapsed over the last 9 years or so. Looks like an unmitigated disaster, right? Well, if you'd simply held some short-term Argentine shillings, you'd be up about 100% over that time period, because you've been compensated with ridiculously high interest rates. And in dollar terms, their equity market, they did a huge devaluation here to reflect the real value of the currency, and the market panicked. I don't want to own Argentine assets, but when you're seeing big reforms being done and tough medicine being taken because it's the right thing to do, it's usually a good sign. And of course, from there, not of course, but from there, the Merval, the Argentinian stock market has doubled in a very short order. So you always like to see an emerging market taking tough medicine. As a trader, you want to be always aware of central bank meeting days, especially when there's a lot of talk of new policy moves. Here I've circled central bank meeting days during 2013. You saw some absolutely massive moves, especially relative to current market volatility on those days. And indeed, they set the direction often back then, and they often do today as well, but there was more so back then because there was more question about what's going to happen next, and the central bank's guidance was extremely important. And here you see a big move down, set the tone. A key meeting that sees the low and a massive bar higher, classic candlestick, and you're off to the races for a couple of weeks, et cetera, et cetera. So these are central bank meeting days. You can't underestimate how important they are. And even when they simply send out signals. So back in 2010, the classic one was Bernanke hinting that quantitative easing 2 is on the way, sets everything in motion for the Australian dollar to appreciate very rapidly against the US dollar, in general the dollar down, especially gold and silver went absolutely nuts on this day and went straight up as well. And it's all, as with equities, it's all in the anticipation more than the reality. So when the Q2 actually begins, it only goes up for another couple of days and then goes flat for a couple of months to sort of digest the whole move. Similarly with the Bank of Japan and Abenomics, you got a sense, oops, there's a new election coming in December. Mr. Abe looks like he wants to bring something new. We don't know what it is, but it sounds like it's really going to weaken the yen as a key part of the platform. Everybody piled in, and he was elected in December, took office. The actual BOJ policy announcement was not made until April, at the very end of Q1 or very beginning of Q2. So it was all priced in before the fact. Not all, but most of it was priced in before the fact, and only rallied. It did rally respectfully, because the announcement was even bigger than anybody in their wildest dreams could imagine. But it's still, the bulk of the move came actually before the announcement. A bit on China, essentially taking over the world, and we only mean that partially for sure. And then a little on trading. I think the only thing I want to say on trading, and you can ask about any specific pairs, because I'll see if I can pop open my trader here. We can look at a couple of charts live. Is that I do really simple stuff. I like to have some basic technical things in place, and then use fundamentals as a backdrop, with technicals as the trigger on why to make a trade. And if the two are not agreeing, then I'd be more likely to trust the technicals than the fundamentals, because it could mean that I'm wrong. It's a lot easier to believe you're wrong on the fundamental side. So, for example, dollar Canada here, we do my favorite indicator for trend, sort of short to medium term, is the 21-day simple moving average. So that's the pink line here. Oh, sorry, it's the green line here. And you allow, for example, not just a cross. So here you have, for example, you're coming into this phase here, you have a couple of crosses, but you're not getting follow through. So these are your pivots. Once it's created a local low, in this case, below, that's your pivot level. And it's not until the pivot's broken that you maybe have a trade. So here's the attempt to get back through. And really, it's a messy market, a churning market here. You're seeing a bit of a lack of trend. It's trying to take out a getaway from 130. The big break here is, here's a false break, for example, a rejection. But notice also the action developing around the round level of 130. I think round levels in currency trading are underappreciated as a factor psychologically. And you saw at 130 providing support a couple times. I also like to use candlesticks, a very nice candlestick with a large range here, hammer. And finally, you see these, these attempts. There's one attempt through this high at, 132 and change, 132.50. This attempt failed, this attempt failed. And finally, the close above, this nice close above with very little additional tail, shadow on the candlestick is the one that sees a bit of success. And you're off to the races. Now, when we get to this prominent high here, the fact that this is just my way of looking at sort of a fractal approach, if you will, where I look at the major highs and major lows that have made. So the major level here was 132.50. That was finally broken. And now we take it back out on the downside on this sell-off wave. That's really disappointing. And it doesn't mean that we're going to go straight lower right away. What it means to me is that we've weakened this attempt at building a stronger and longer-term uptrend. So then you can look at retracements. You can look at signs that a fresh approach. It could be a double top. It could stop at the 61.8% retracement. It didn't in this case. In any case, it does stop at the top and very slightly beyond. And then you wait for your pivot. The pivot took too long to create below the 21-day. But anyway, the structure to me was ruined by this sell-off taking out the whole previous high levels. And again, once you come back down here, this round 130 level becoming very important. Multiple attempts to break, they don't. And then you can develop small local pivots above the 21-day moving average. This one, that's the pivot is established. It was never broken. We went back lower. This pivot here, which was the low pivot, we never got a good chance because the action was so steep. But here we've established some pivot lows, and we know the 130 is pivotal anyway, but it never was taken out on a closing basis. So we're frustrated. We're waiting for either a downturn or a new upside pivot to develop. Develops a pivot point here above the 21-day. We never close above. It matches it here, never close above. Boom. Now we have our strong bar upwards again, a small upward shadow, and it's unfortunately almost a lot of the gains were on that very day, but it did run higher for 7-8 days. And then similarly here, that's that 130 setup I was talking about. That was the run higher. It never follows up, but then when it goes back down, this is the local pivot here. This is the 21-day again. We establish a pivot here, and we're waiting to see if it breaks. This sort of keeps the range intact. We break it here, so one might have gone short on this day, on this close, and then the rejection immediate the next day is a bullish reversal because we've rejected the pivot break. So one could get at least half long there, and then we establish a new nice strong bar here that takes out that previous pivot. So we get both pivot broken and the rejection confirmed, and then it takes out a new high. Several weeks of uptrend there, and then darn it, our uptrend isn't going to be a massive secular one. These new highs, these were key secular highs that were made for the year, and that sequence failed. And that failure was confirmed here, and there were some big fundamental developments in here that confirmed that as well, with the Bank of Canada changing its mindset on interest rates. And you had a very nice steep trend with some very strong and clear fundamental supports on the downside, with this pivot being taken out on that bar, this pivot being taken out with this bar, et cetera, et cetera. So it's just a way I look at markets. I like the 21 days as a basic trend indicator, establishing pivots, breaking those, momentum trading, occasional reversals when the breakouts are very clearly and neatly reversed, etc. Occasionally momentum divergence, that sort of thing. I don't know what's of most interest for you all to see, if I've already spoken too long, or if you'd like me to pop into any specific pairs right now.
Altså, folk er egentlig interesseret i at vide, om der er et valutakryds, som du i øjeblikket mener er helt oplagt for et swing trade. Nu ved jeg godt, det kan være svært for dig at komme med den slags.
There's I can look at there's some key contingency. I think we got a key data point tomorrow, for example, in the U.S. Where we're looking for. I assume you can still see my screen, and I'm going to pop this over where we have a look at a couple. So a couple things going on right now. This is hopefully I'm getting full screen without interacting with the application. Yes. So we've seen a big Brexit trade here, where we've seen the big positive UK news. This is euro versus sterling. Unfortunately, we're still in this big range that's been established. We're all waiting for big news to develop. But if you see, we have a mid-December EU summit. And if we see this big line in the sand broken 87.50, and I think arguably one could have a position on now for looking to at least probe these lows. But if this is giving way and we're seeing UK rates continuing to advance higher, and I think there's plenty of room for it to fall towards 85. In other words, for sterling to rise based on a reassessment of how bad or now better the Brexit process is going. And if we look at dollar yen, we're seeing it attempting to rally today. We've seen a big move in treasury markets today, a big sell-off. If that sell-off extends, and tomorrow is a key day for that, because we have the U.S. inflation data up tomorrow, the so-called PCE inflation data. If there's a big surprise there, and we see a pretty big move in U.S. treasuries. In fact, I think I can pull up the future here on the U.S. Treasury note. You see we had a pretty chunky sell-off in the treasuries today based on some stuff that Yellen was saying. I'm not sure it's a bit grayed out this chart, maybe because I need to go to the March contract. That's something I trade much. I look at it every day, but I don't trade it. And if you look at the actual 10-year benchmark, if you're seeing U.S. rates pointing strongly higher, I think it's short-term supportive for dollar yen. It could see dollar yen driving back up towards that 114.50 high. If you see a disappointment, on the other hand, it's going to be ugly for the pair, and you can see we're mid-range. So it's been a very frustrating trade for trend traders. It's been more of a mean reversion trade. So like here, the sequence here is a nice rejection of the attempt to break out of the range to the downside. Right now, we've rejected partially this attempt to keep going lower. The sell's been very hesitant, but I'm not seeing a super clear signal. And then unfortunately, a lot of the moves recently that we've liked, like Aussie dollar lower, they've just been going down for a long time. Market's getting positioned for it. We've already had like 3 waves, so maybe it tactically goes up here, 77, 77.50, but we still like it lower. We're not sure. We just know that strategically we like it, back in the low 70s again. It's just a bit difficult when you've already had some very nice moves in your direction, and it's going to depend again on the U.S. Interest rate outlook. So sterling, I think, is one of the more interesting ones. If you want a dollar negative trade, and we get bad inflation figures out of the U.S., we've seen a pretty key break here in sterling versus dollar, so-called cable, for those of you who want some jargon. And if you'll notice as well, a technical thing to be aware of, and it's quite prominent in foreign exchange markets. Where are we about to close the day? We're right at that 61.8% retracement around. Actually, it's closer to 134.20. This is based on the bid prices. So we did go above it, but that's what's attracting the price action into the close. So again, more positive Brexit news. And if it's the dollar that's weak instead of the euro, then sterling versus dollar is maybe more to prefer versus euro versus sterling.
Hvilke tidshorisonter vil du anbefale tradere at handle på? Altså, der er jo mange, der sådan forsøger at skalpe Forex-markedet, men hvad er din tidshorisont, hvis man skal have succes?
That's a great question, and I think it depends on what you're looking for and what kind of leverage you're using. I think it's a very individual thing. To me, I really do think, of course, one should always test one's ideas out with, even fake money or tiny risk, no matter what, if you're getting your feet wet. To me, Eurodollar, for example, it does not trade the way it used to do on an intraday basis. I used to look all the way down at intraday opening ranges and 5-minute bars and support and resistance and breakouts. To me, it's become much more erratic and choppy. And as well, you have to be aware of where the volatility is. Let's slap on an average true range here for Eurodollar, for example. 50 period. Let's use a exponential. It's actually not that bad. We're just 70, 75 pips in Eurodollar. But you can see that's at the relatively low end of the range. So intraday moves are quite small. And look, look where we've been before, 125 pips. If you go back to the whole Euro crisis thing, we're at 175 pips. Enormous intraday swings. There are more opportunities. So you need to take a micro. If you want to trade intraday, you need to be aware of, are there even any opportunities intraday? Also be aware of, for some reason, Eurodollar statistically is almost untradeable on Mondays. So there's almost no volatility on Mondays anymore. And if there is, it's probably because it's been a big news item over the weekend or something. So my preference is to look for the 2 to 3 day trade if you're talking about a short-term trade based on, let's say, a rejection. Or, so for example, here you had, I've drawn the line here, you had a good head and shoulders formation developing. Here, if you talk about a 21-day, again, here's a green 21-day line. So we had a pivot, and that pivot was finally broken. Here, it didn't really lead to a high energy move lower. And again, are you really wanting to look for shorting opportunities when you've just had the most massive and sharp move higher in the euro in a long, long time? But you did have a very clear head and shoulders formation developing that was pretty easy to trace out with a neckline here. And this bar here seemed to confirm it. So you get short, and it tested the line once, fell to new lows, but those new lows didn't hold. That's a bit of a disappointment. Comes back up to the neckline and then breaks. So there was very little opportunity below that. But this key bar here means you need to start looking for long opportunities. So let's look at a retracement and say, well, I want to get long on the dips, and you're looking for a 3-day advance for short-term advances. That's about what you get from wherever it bottoms. It's 3 days of up. And I would say the 2 to 3 day advance, and then you have the 9 to 11 day advance, and then you have what I would call more of a sort of a secular move where you're really looking to just sit on the thing for a couple of months. That's very hard for many to do. That's not really trading. That's more a macro conviction trade. But those are the 3 time horizons I personally would look at, and to combine fundamentals with the technicals.
Okay. Så er der mange, der er interesseret i dine tekniske indikatorer. Du har vist din glidende gennemsnit. Du bruger også Fibonacci. Er der andre, som du kan lide at bruge?
Yeah, it's a good question. I'm really untechnical trader. I don't, but at the same time, I'm very chart oriented. I just like the quality of the price action, the quality of the situation and the context when things are happening. So I never like to look too much at a single indicator, and especially I get concerned about things that have, let's say, a 9 or 11 day window. I mean, if we're all waiting for some key event risk that we know is 47 days out, what the heck does a 9-day window tell me about anything? It's so arbitrary. So it's not, to me, it's a low quality type of indicator. Now, some of that, with that said, something like MACD can be kind of interesting when you see divergence on some of these indicators. That can be interesting. But that divergence comes with the context. Now, what I mean by divergence is something like, let's see if I can recall from the top of my head. Aussie dollar. And I even don't even use these indicators the correct way, if you will, sometimes. What I mean by divergence, let's take something like, this is a huge secular fall in Aussie dollar. And I'm not even sure it's going to show up on the MACD on the daily, but it'll probably show up in MACD on the weekly. But let's see what we got here. Okay, there's pretty good divergence here. So you've had this, absolutely enormous slide in the Aussie dollar. It's seen a tremendous revaluation. And when you're looking for taking profits, you're looking for maybe when your divergence is flagging. So now initially when moves are just getting started at new low prices, your momentum indicator may not be making new lows. But if you see, for example, here you're getting new lows and you've had the MACD at a much higher level than the previous low. Now that's natural because it's kind of this long period of consolidation has meant that the MACD dribbles back higher. But if it just stops going down and starts going sideways and you get a couple of up days, you're just getting disruption. And in fact, you have what's called, but I don't know how technical my audience is here, so many of you maybe completely preaching or talking to the converted, you could have what's called a triple divergence. So you have low, even lower, but the MACD is low, higher, and even higher. So yeah, that's a classic sign that the energy of this move is simply flagging for now. And indeed, we saw a pretty chunky reversal from 75 all the way well above 80. And then even on the next move, see, these moves are too far apart here. But if you smack it out to a weekly, and which is fair to do in this instance because we're talking about an absolutely epic move, you can see that and I don't even know this, but I'm assuming, yeah, indeed the MACD. So low, low, even lower, lowest, less low, higher. And that is not really confirmed until you just see the movement has stopped and it starts reversing. So you need a little confirmation on some of these divergence moves. And these are better for sort of strategic longer-term trades, but it's just a valid way, I think, to see where maybe you are and to quality check where a trend is. And now another point I wanted to make on that very same thing is that very same chart. Aussie dollar has been a mess. Well, it was a mess for quite a long time. So yeah, this is one of my classic setups that I like to look at. And it combines all these things. So here we had a divergent low, which we don't really know about until it really starts. That was on the weekly, this one. Goes sideways. Now, here was the major swing low, if you will. Now, I'm not using the 21-day moving average. I'm just using, this was the massive secular low at this point. Big down day, tries to break it. Boom, immediately rejected. So very interesting, right? Immediate rejection. Well, is that enough to reject it or not? Where do I test it? I don't want to just immediately jump on this attempt to get some upside momentum going. Maybe I use a Fibonacci retracement. And then, or I don't even know if I want to do it at all yet, but then it really reverses almost the entire move to that new low. Again, a classic sign that the trend is being rejected. The attempts to continue the downtrend is being rejected. Long period of consolidation, a really sharp attempt to establish a new low, immediately rejected. Where do I get in? Do I get on these new momentum highs? Well, there are going to be a lot of people still wanting to sell would be the argument. And maybe what I want to do is get in on weakness rather than on strength. Normally, I like to get in on strength for a trending move. But if the idea is that I'm trying to catch a turning trend, then my mentality is different. And I might look for something like a Fibonacci retracement, 618. And that proves to be the support line here. On what I call a throwback, trying to throw back to the old trend, but we've already turned the trend here. And then when you can start getting momentum trades is when this was the throwback, this was the rejecting the old trend, and then the momentum for the new trend is when we start to break these interesting pivot highs with this bar here, for example. It's also having to be the 200-day moving average coming in, et cetera, et cetera. So that's the kind of the way I like to look at to market use the combinations of factors. Fibonacci, pivots, 21-day, etc. Nothing fancier than that. No, very few of these types of indicators. The time, I forget what the class of indicators is called off the top of my head, but certainly no stochastics or RSI. I've just never found this useful. But it's because I like to look at the price bars themselves rather than some derivative of the price bars. Whereas I feel the MACD sometimes can give you a sense over a bit broader, a longer term time horizon. And I do something weird as well. I often change this to 19, 9, and 7. It gives me a little bit of a faster MACD. Just use whatever you want. I found some pretty decent results on one attempt I did at trying to make a system that it seemed to be better to have something that's a little bit faster than the typical parameters. And that could depend on the instrument. Maybe Forex is going to be different from your equities. Or I know it is, but it's going to depend on your instrument as well. Ja.
Så er der en, der vil høre, om du vil kigge på pundet over for yen.
Pund yen, yeah. That's a combination of things here. Now, this could be doubly interesting. That's a very good question here. First of all, I like that this line has been maintained. This, unfortunately, my little widget here from this application I'm using is there. There it is. Okay, it's around 147. This line in the sand here. If you're trading And I should say there is one more indicator used, but just purely from the price action without me talking about that. Just look at where we are in terms of this line. This is, of course, these are the previous highs, but if you look at that 147 area, it just seems awfully pivotal, right? The previous close actually more like 147.50. So 147.50 to 147 seems to be pivotal. The actual lows, range lows, are towards 147. We have a nice sort of very sharp rally. This was the big recovery in the pound that happened elsewhere as well. And then all the the Brexit worries flared up again. We're still uncertainty, blah blah. You could argue this is sort of a pennant formation or a flag formation, in which case you need to see a good strong close at least to if you're looking at classic. And I hope you're all familiar with Edwards and McGee. If you're not, you need to get the Edwards and McGee book to get all your classic price formation fundamentals in place. You at least need to take out the descending trend line, but I prefer at least 150, a very strong takeout of 150 and above this line to see progress higher. And the doubly interesting thing here would be if that interest rate move I talked about, for example, we get both a good positive Brexit vibe and we get interest rates picking up, because in the first instance that's going to be very yen negative, and we can see an interesting progression higher. The one thing I was going to mention here was something key, and that is if you're trading Japanese currencies, especially the Japanese currency, it's very interesting to look at what's called Ichimoku. And we have this, and I'm proud to say this actual platform, at least as of one time when I was checking it with the Bloomberg charting expert, actually was doing this the right way, and there was like a day off in their calculations. Ichimoku is look it up. It's too long to explain it if you're not familiar with it already, but it can be very interesting, especially for target levels if you're looking for where support or resistance might be. But you can see a lot of these levels are lows coinciding with the so-called cloud levels on the Ichimoku daily cloud. This is a system developed by a Japanese trader. Broke into the cloud. That was a big moment of concern, but then we saw a nice rejection and a pull higher. And it works, not works, but it's something that's looked at both on a weekly and a daily basis. Sometimes it's interesting. Sterling yen is a bit of a cross rather than like the main traded yen currency, so it might be a little bit less valued for indications than, for example, dollar yen. But Ichimoku is certainly just one to be aware of in terms of levels for intraday, or for if we're getting towards the end of the day and there's been a down move and one is wondering where to take profits, and there happens to be a handy Ichimoku line there, one might consider on putting in a bid just ahead of that Ichimoku line. And in fact, for example, here that defined the low of the day and did so for the next few days as well. Yeah, but I'm not a dogmatic on any of these indicators, and some of it's always going to be random. It depends on the news flow as well.
Okay, så er der en, der stiller lidt et makrospørgsmål igen. Du viste før det her med, at markedet stiger på forventningerne, og når politikken så slår igennem, så kan det være, at markedet virkelig trækker sig lidt tilbage. Det er vel også noget, man kan forvente her med Donald Trumps tax reform formentlig. Vil du forvente det?
Well, that's a very good question, and the key to understand for anything is what are the expectations. You can be right in different ways and wrong in different ways. You can be right that it is supportive for X if, for example, tax reform happens. But what may be a bit more difficult to discern is whether the market has priced it in or not. And I'm not sure I understand how much the market is priced in. The market is extremely long in the euro versus the dollar. You can see that in the CFTC, the U.S. futures report. Very, very long. So maybe the market's not really ready for tax reform. I'm not quite sure I understand how ready they are. And I think the readiness, and one of the reasons I point to the PCE inflation release tomorrow. And sometimes the reaction to one number is actually not about a reaction to that number, but it's about a reaction to something else. So maybe, let's say the PCE inflation data in the U.S. comes in, and this is pure speculation. I don't know. We're going to have to see how the market reacts, but it's really nice when you get a tell. And what I mean by a tell is this. A tell could be that you get a PCE inflation data that's absolutely completely in line or even lower than expected. Supposedly bad for the dollar, supposedly should mean that U.S. treasuries go up, U.S. yields go down. But what if we get that, and the tell would be that U.S. long yields rip higher, bonds collapse anyway, and the dollar goes straight up. That means people are starting to say, oh crap, this tax reform is going to happen and we're not ready for it. Because you just got a data point that said one thing and the market's not reacting to it. So then this kind of things happens all the time. So that, the so-called buy the rumor, sell the fact can be one thing, or it can be we think we've anticipated what the market is thinking, but we haven't at all. It's very difficult. So I'm not sure I understand how much the market is priced in tax reform. I think it's priced it in a little bit. The dollar's picked up a little bit here, but I don't think it's priced in much.
Folk siger jo ellers, at aktiemarkedet generelt er steget på grund af, at de venter på de her tax reforms. Men det er måske ikke så givet.
Has there been anything that has made the stock market fall consistently over the last year? I'd like to tell you what it is if it has. Because I'm being silly, of course. The narrative hops. First it was this, first it was that. I think it's hard to build a story on why the stock market has advanced, besides the fact that it's just advanced. Okay. Maybe it ripped higher yesterday. We also have a market that's enthusiastic about the new Fed chairman because he's an anti-regulation guy, and it sounds a little bit like he's willing to let policy run a little bit loose. That's the assumption anyway. We don't know, but that's the assumption. So he seems to be supportive as well. That could be another reason the market went up yesterday. So people love to have a reason. I think the longer you trade these markets and the longer you try to find reasons for things, the more you realize you have no idea sometimes, and things are just doing what they're doing. And you just need to be on top of, especially situations where it's clear the market is thinking one thing, that thing happens, but then the market does something else, or vice versa. I think those are the most interesting gotcha moments in markets. One of the best ones being, for example, dollar yen, or the yen in general, back in early 2016. I can show it for you here. I keep forgetting I'm actually on the screen with you folks. Early 2016, the yen was ridiculously weak, so weak, in fact, that despite their crazy level of easing, that Kuroda, the Bank of Japan governor, was actually out warning the market. He did not want the yen to go any weaker. That's how weak it had gotten. So the market took that into mind. That was right here, 125. So it's clear, 125 is our line in the sand. We don't want the yen to go any weaker than that versus the dollar. So it got a bit volatile here. I can't remember the reason for this. Is all the way back in 2015. And then in early 2016, they went to a negative interest rate policy because they were concerned about deflation again. Supposed to be a new dramatic level of extreme monetary policy, supposed to be extremely Japanese yen negative. And in fact, it rallied for maybe one day. I think it was on this day that the announcement was made. And then the yen launched a absolutely brutal consolidation to the upside on what was supposed to be a yen negative development. Maybe it's just a question of price. Maybe that was the chief reason that this happened. Maybe the market just put too much into selling the yen and forgotten and overrun itself, and they just needed a positioning adjustment. That could be the whole explanation of why it went from 120 to 100. I think another thing that was driving it was I know that was early. So yeah, I think that those kinds of things happen as well. But I think that was a big tell. That was a very key tell when you have a massive event that doesn't turn out the way one would logically think it should, and that means there are other reasons afoot for why something is happening. And this gives good perspective, this chart I have here, how hopeless dollar yen is at the moment. It's essentially been in a range for a year. So we're waiting and waiting. And a lot of that is because also U.S. Treasuries have been in the Treasury outlook, the long yield outlook in the U.S. has been flat for so long and uncertain.
Okay, John, vi har jo ramt tidspunktet 1,5 time helt perfekt, og det har været super spændende at høre også om de her fundamentale forhold, som nok mange overser, når de sidder og trader Forex. Jeg kan så fortælle, at mens vi sidder her og snakket, så er der sket noget i vores kære Bitcoin, som vi indledte med. Den er faldet 17% lige pludselig.
Yeah, great timing on my part then, huh?
Den er faktisk gabet nedad, men nu er den så på vej med rasende fart op igen. Så ja, markedet er fuldstændig uforudsigeligt.
Yeah, I'm sure, yeah, it will.
Trader du selv bitcoins?
I do not.
Okay.
I do not.
Okay. Men
I have too many gray hairs on my head for that market.
Ja, you're a wise man. Tusind tak, John. Jeg er rigtig glad for at have haft dig med i aften, og jeg er sikker på, at folk har fået noget ud af det. Så jeg håber, at vi kan se dig en anden gang, og så må vi over og kigge på bitcoin-kursen her, inden vi går i seng. Men tak for denne gang, og jeg håber at se jer igen i næste uge, hvor vi har endnu et spændende webinar om Forex ved Dan Juhl, som vil snakke blandt andet om optioner. Så jeg håber at se jer igen. Hej hej.
Hej, tak.